class, we ended by talking about the difference between adjusting entries and closing entries. We left off by talking about adjusting entries and permanent and temporary accounts. We did not get to the closing entries, so we ended here, correct?
Yes.
Okay. We're going to start with talking about our closing entries. So, with regard to our temporary and permanent accounts, we already talked about that. We have these permanent accounts, and then we have the temporary accounts. What we have to do at the end of the fiscal period is we have to actually close out these account balances for those temporary accounts, and then go through a process. We have to go through a process of rolling the balance then into the capital account, because as we've already said, that's going to roll into that capital account. The net profit, the drawing, we're going to roll those balances into the ending capital account, as we discussed in chapters 6 and 7 with that capital account equation. So we do this by reducing the balances in those temporary accounts to zero, and then that prepares those temporary accounts for the new fiscal year, because their balances are now at zero, they're fresh. And then this also applies, this is the way that we go about applying that matching of expenses and revenues during a fiscal period. Because now we're taking all that information relating to the revenues and expenses for that period, and we're closing them out and we're putting them together for just that fiscal period. Okay? It's not like the revenues from one period carry over into the revenues for another period. That doesn't happen. Good? Move on? Yeah. Okay. So the closing process is just really where we take an amount that is equal, an amount that is equal to the temporary account's balance at that point in time, and we record that balance on the opposite side of its normal side balance to close it out to zero. So what ends up happening is whatever the balance was, if we close it out by putting the opposite side balance, or putting the balance on the opposite side, then that brings the balance down to zero. So if we have the revenue account, if you think about the revenue account is always a credit, right? Should always be a credit balance. So to zero the balance out, what we do is we do a debit to the revenue account, right? So if we have a $3,565 balance in our revenue account, and then we debit the revenue for $365, then that closes the balance to zero. And then we roll that into the capital account, ultimately. So we already kind of did this in our accounting log, so I'm just going to put these up here. You guys should be able to know that off the top of your head. You could just put P, T, however that, like that, P, T, right? Because you guys will know, right? All right? P, T, right? Good, yes, maybe?
Yes.
Wait.
No, wait, you can think about this. You know it.
All right, I'm good now.
Okay, so now here's where we use that income summary account. Remember when we did the worksheets back in chapter 6, we put that income summary account down there. You would have your assets, you have your liabilities, you have your capital, you have your drawing, and then you have the income summary. This is where the income summary comes into, we're finally really going to use the income summary. This is the account that we roll our temporary accounts into to transfer them to the capital account. So the income summary is the ultimate temporary account, because its only purpose is to close other accounts into it, and then we ultimately close out the income summary and roll that into the capital account. It is a unique type of account because it has no permanent side or, normal side balance, because its balance will depend upon whether you have a profit or a loss. Okay, so because we're going to roll revenues into it and then we're going to roll expenses into it, its normal side, it doesn't really have one, because the balance will be on whichever side is the positive side or the higher side. Okay, so its balance is determined by amounts posted into the accounts at the end of the fiscal period. So it will have a credit balance when revenue are greater than expenses, because the credit balance is a net income, right? So when we think about it, revenues are greater than expenses, right? Expenses, normal side balance, or what? Debit. All expenses, normal side is debit. Revenues, normal side balance is credit, right? So if we have a credit in our revenue that's greater than our expenses, so if we had, say, $5,000 in our revenue and we had $3,000, this is a credit balance, expenses are a debit balance. If we had $5,000 in revenue and $3,000 in expenses, then we're going to have a credit balance at the end, correct? A credit balance is going to be a net profit. Credit balance is going to be a net profit, right? Does everybody agree with that? Good. Okay. Now, if I had $3,000 in revenue and $5,000 in expenses, then I'm going to have a net loss, and this is going to be a debit balance. Would everybody agree with that? Does that make sense? Okay. So, if you want to write that down, just that, if that helps you. Okay. So, that's just how the T accounts work out. So, if you have a debit balance, it's basically where your revenues are going to be less than your expenses, and you have a net loss. So, closing entries, just like with adjusting entries, we will go through a closing entry process. They have to be done in this order. What did I just say? Right. Okay, so we're going to go through and we're going to close from our income statement. We're going to close our balances with credit balances. Hold on. Yeah. So, first thing we do is we close out our income statement accounts with credit balances. What are our income statement accounts with credit balances? What? What's on our income statement that has a credit balance? Pardon me? Oh, on our income statement. What's on our income statement? Sales, right. Sales. So primarily, we're talking about our sales or our revenue accounts are on our income statement with credit balances. What's on our income statement with debit balances? Expenses, all of our expenses. So we're going to close those out in that order. We're going to close out our sales, then we're going to close out our expenses, and then we're going to close out or record whether we have a net income or a net loss. So we're going to close out the income summary account, and then we're going to close out our drawing account. So the order goes sales, expenses, income summary, drawing. That's the order. Okay. So first thing we do when we do our closing entries, we're going to look at, we're in green up here. In green up here, we see the snapshot of our income statement from the worksheet. See how we're in the income statement columns on the worksheet. And the first thing we're doing is taking the credit balance, which is our sales, And so in order to, so this is, the lower half is our journal. So now we're in our general journal. We're going to put another heading, just like we had a heading for our adjusting entries, we're going to have a heading for our closing entries. We're going to have that date carried down because it's the end of the fiscal period. And so we're going to close out our sales. So if our normal balance is a credit, we're going to close out our sales by doing a journal entry that's a debit. Okay? So we're going to debit sales, and we're going to roll that sales amount into the income summary. So we debit our sales, and we're going to credit income summary. So now, where is the balance of the sales? It's in the income summary account. We've just basically transferred it to the income summary account through this journal entry. So we write the heading, we write the date, we write the account title for the debit, and we write the amount, and then we write the account title for the credit and the amount. Typical journal entry. Now, for our expenses, there's usually multiple expenses, correct?
Yes.
Technically speaking, we could do each expense one expense at a time. But from an efficiency standpoint, that doesn't make a lot of sense. So we'll do a compound entry, and all that is an entry that has more than one debit or credit. In this case, we're going to close out all of our expense accounts. Again, we're getting this information from the worksheet columns, from the income statement section of the worksheet. These are all debit balances, so to close them out, what do we have to do? We have to credit them. Right. So, how do I know the amount of this credit? How do I know? What should that amount equal to? What do you think? Picture your worksheet in your mind. Picture your worksheet in your mind. Everybody got a picture of your worksheet in your mind? What's at the bottom of when you total this up? Don't you get a total?
Yeah.
Right? So that's the amount that should be getting debited to the income summary. The total of all your expenses is the amount that should be getting debited to your income summary. And then we are individually closing out each one of these expense accounts by crediting them because their normal side balance is a debit. So to close them out, to get them to zero, we put a credit. All right, and that adding up all of these amounts should get us to this 1466. Okay, so here we go, same thing. We're going to use the date, the income summary, and then we're going to credit each of these. That's our journal entry. So if you see here, now, what do we have? We have the total here of our credits. Again, what am I looking at? I'm looking at my worksheet. This is the total of the credit, which was the 3565 for the sales. The total of my expenses, 1466. We rolled both of those amounts into our income summary. The difference between these two, the 3565 and the 1466, is our net income or our loss. It's exactly what we did up there on the board. So right now, the balance of my income summary should be the $2,099, the difference between these two. So I'm going to take that amount, and I'm going to close out now my income summary, and I'm rolling, in this case, my net profit into my capital account. So I'm going to close out my income summary. See, I've got a credit balance in my income summary because my credits of $3,565 are greater than my debits of $1,466. So I'm going to close that $2,099 out and roll it into my capital account. So now what did I do? I first transferred my sales into my income summary. I second transferred my expenses into my income summary. Now I'm going to close out my income summary and transfer it into the capital account. Okay, and that's the steps. Last piece, last closing entry is my drawing account. I go over to, again, my worksheet. I'm now in the balance sheet columns. going over to the drawing. My drawing is normal side debit balance. I'm going to close that to my capital account. And in order to close it, I'm going to credit my drawing and I'm going to debit my capital, which makes perfect sense because we know that the impact that the drawing is a negative impact on our capital account. So we're going to debit our capital account to reduce the balance in our capital account by the amount of the drawing. Is this making sense? 5s, it makes sense. 3s, 2s, all right, you guys seem like you're good. Okay. Those are the steps. All right. So then we go through the process here. If we look, you guys, it might be a little bit hard to see. Let me see if I can blow this up. Okay. If you look at here, let's pick an account that's a temporary account. So our permanent accounts, we don't close them. We don't have to do anything. They roll to the next period. So the balance in my accounts payable account of $200 that we see here, my accounts payable, that's going to be the beginning balance for next period. However, if we look down here, my Kim Park capital account, we just closed that drawing. We rolled it. If we look at my capital account, what do I see in my capital account here? In my capital account, I see where I have my beginning capital of $5,000. I have my net profit. Remember, we just had that $2,099. That $2,000 is now added in here, and I've added it to my balance. This $625 drawing, I've taken it out. I've debited it. And that reduced my balance of my capital account. See how I went from $5,000 to $7,099, and then I decreased it to $6,474. Then if I look down here at my drawing, see how in my drawing account I had a balance on August 31st of $625. Then I closed it out by crediting it, and I brought the balance down to 0. Where did that balance go? It went up here in the capital account and reduced the capital account balance. So this brings my drawing account down to 0. So on September 1st, the balance in my drawing account is what? 0, right? The balance in my drawing account on September 1st is 0. Same thing down here. Let's go to my sales. See how my sales, my balance on August 31st, I had up to $3,565 in sales. I closed it out. Okay, brought the balance down to 0. Where did that go? It went into my temporary account called the income summary until I rolled that balance up here into the capital account. And then the same thing over here with all my expenses. I took those balances, whatever they were, and I closed them all out, each one of them. Brought the balances down to 0 and rolled them each into the income summary with the total of the debits here, bring that credit balance down, and then I closed out the income summary and brought that up into here in the capital account. So everything that the temporary account gets closed out. You bring the balances down to 0. Let's see. Okay, let me get moving here. Release me. Okay. 8-3. Let's move into the last part of the process. Is to prepare a post-closing trial balance. So, how do we prepare a post-closing trial balance? To prepare a post-closing trial balance, what we're going to do is we're going to take all the permanent accounts and prepare a trial balance. Again, what are we doing in that trial balance? The post-closing trial balance does the same thing as the initial trial balance. It's proving your debits equal your credits. But now, it's proving the debits equal the credits only for your permanent accounts. So, on my post-closing trial balance, should I see any revenues? Should I see any revenues?
No.
No. Why?
Well, they're temporary.
Because it's a temporary. And remember, it's post-closing. Post-closing, meaning after you've closed your temporary account. So post-closing trial balance. Okay? So I don't have any revenues, I don't have any expenses, I don't have any income summary, I don't have any drawing on my post-closing trial balance because all of those temporary accounts have been closed and they've been rolled into the capital account. So this is what my post-closing trial balance looks like. It looks very, very, very similar to my initial trial balance, except only with permanent accounts. So you have your heading, you have your account titles. Why can't I find my mouse? My mouse is missing. Missing a mouse. I can't find my pointer. All right. Account titles and then all the permanent account balances. And now you see, what do you see about the capital account? What's my balance for my capital account?
6,474?
Right, it's 6,474. It takes into account what?
All the closes.
The impact of all the closed accounts, all the temporary accounts. Okay, and then we should total them all up and compare them. They should be equal. And then we would double rule to show that we are done and that we know everything's equal. So there is the accounting process. Step 1 is we're going to analyze those transactions. Step 2, we're going to journalize them. These are all the things that we have done so far this year. Then we're going to post whatever our journal entries, we're going to post them into our ledger. Then we're going to use those ledger balances to prepare our worksheet. Then we prepare our financial statements. Then we do our adjusting and closing entries like we just did. Then we do the post the adjusting entries after we do the journalizing. And then we do our post-closing trial balance. And then that's our whole process. That's it. Does anybody need me to stay here longer, or are you guys good? We good? Okay. That's it. You guys, honestly, you know everything you need to know for accounting. Because everything, truthfully, everything you have learned this semester is pretty much everything you need to know for accounting. If you apply any new situation you have to the concepts that you've learned, if you go back to them again and again and again, you will be fine. Because everything fits within the parameters of what we have just done. Okay? Conceptually. You'll learn different things. You'll learn more complex things. You'll learn more complex types of transactions. But if you can fit them all into all the principles that you've learned so far, you know the foundations. You have the basics. Okay? Because it's all just more complicated from here. But these are the basic principles. Alrighty? Alright.
So does that mean that for the rest of the year we just watch movies?
Yeah, that's it. We're just going to watch movies for the rest of the year. Not. Alright, let us do